Hello everyone, and welcome back to our channel Real Estate for Real with Arek and Elaine. I'm Arek, and it is my pleasure to share with you my first solo video. Elaine is probably closing on another deal as I speak. She is unstoppable. As you may know, we are still in a very strong seller's market, which means low inventory and multiple offers situations are our new normal, especially when the houses are priced right. Some buyers might get discouraged by that and look for an alternative option. That's why today's video I would like to talk about short sales and foreclosures. What they are, what are the main differences between them, and most importantly, what are the risks for buyers who would like to pursue one of these paths of purchasing a home. Although these two options are not recommended for first-time home buyers or anyone with a specific time frame to move. Let's start with the definitions. A short sale happens when a homeowner owes more on the mortgage balance than the market value or sale price of the property at the point the owner wants to sell. Essentially, the homeowner is asking the mortgage lender, typically a bank, to accept a lesser amount than the total mortgage owed. For example, if the homeowner sells the house for $250,000, but the remaining mortgage loan balance is $300,000, the seller is essentially $50,000 short on paying the lender back. That's a short sale. Foreclosure, on the other hand, is a legal process that happens when the homeowner, although borrower might be a more appropriate term, is unable to make mortgage loan payments for a significant period of time. Usually, after 3 to 6 months of missed payments, a lender will issue a notice of default. This notice is to let the borrower know he is at risk of foreclosure, and when they foreclose, the current owner will be evicted. Borrowers can try to settle their loan debt with their lender either through a short sale or by paying the mortgage balance they owe. This period is called pre-foreclosure and can last anywhere from 30 to 120 days after receiving the notice of default. If the debt is not recouped, lenders will step in and foreclosure on the property. They will schedule a foreclosure action to sell the house to a third party that typically is held either at property or the local courthouse. And little bonus definition here: if no one buys the home at the auction, the lender becomes the owner, and the house is considered a bank-owned or REO, which stands for real estate owned property. But that's a topic for a different video. Now, when we know all the definitions, let's talk more about the differences. And the primary difference is in who is selling the property. With a short sale, as you may remember now, the bank allows the borrower to sell the home for less than the outstanding loan amount. Foreclosure is when the bank seizes the property from the borrower and attempts to sell to satisfy the outstanding loan amount. A short sale is a voluntary process. Foreclosure, on the other hand, is involuntary. In this case, the lender legally seizes the home after the borrower fails to make payments. Before you take the plunge, it's important to know exactly what would you be committing to in the event that the lender accepts your offer. So let's dive in. Although the name might suggest otherwise, short sales are anything but short. A short sale can drag on because it needs to be approved by the third party, the seller's mortgage company, since it has agreed to take a loss on the loan. Like many corporate institutions, these lenders don't move quickly. You could be waiting 3 to 6 months before the bank even accepts your offer. Many different parties will need to review the agreement and decide if your proposed sales price is acceptable. So be prepared to wait, especially if you live in the area where this type of sale is common. And that's another risk. While waiting for the sale to move forward, you could miss out on the other more secure buying opportunities. Next, In a typical home sale, there is contingency period in which the buyers are able to perform inspections on the property. Afterward, they will negotiate with the sellers on any repairs that should be made in order to ensure that the property is in safe and livable condition. However, on a short sale, what you see is what you get. You don't know about the condition of the mechanics of the house. That includes plumbing, heating, cooling, and electrical, and how well they operate. There are no warranties on the property. Buyers of a short sale should be prepared for the possibility of structural problems, pest infestations, or any number of potential issues that may end up driving up the house's cost over time. Keep in mind that there is also no guarantee you will know upfront what the home's problems are. While some banks allow interested parties to perform inspections on the home for their own benefit, others might reject any offer that elects these contingencies. Why? Since the banks are already taking a huge hit on the sale price, some will not want to risk allowing a potential buyer to walk away after learning that the property requires extensive repairs. Another risk. From the get-go, short sales often require larger payment to the bank upfront because banks are more likely to choose a buyer who can put down a cash offer or sizable down payment. Again, why? They just view someone with cash as less risky than a buyer who needs a mortgage. Depending on the terms of the purchase agreement, the buyer might also be responsible for any costs associated with the sale. This can include the cost of any resale certifications, an appraisal, or a title insurance. While these are usually split between the buyer and the seller, in a short sale the bank is often unwilling to take on any additional costs. And although the buyer and seller might agree on one sale price, keep in mind that this number won't necessarily end up being the final purchase price. The bank could decide on a different bottom line. As you can see, while short sales seem like a great deal at first, there is a chance they could end up costing buyers in the long run. So before you tie yourself up in one of these transactions, make sure you know exactly what you're getting yourself into. Let's now take a look at risks related to foreclosure process. How a home is purchased at an auction is very different from traditional purchase. In Connecticut, you are typically required to bring a certified or bank check made payable to the bidder in the amount of 10% of the fair market value established by the court. Then, the successful bidder must be prepared to pay the balance of the purchase price within 30 days after the approval of the sale. Another important factor is that you can only do a walkthrough inspection, usually on the same day, 2 hours before the auction starts. It is also possible that the former owner is still occupying the house when it goes to auction, and if they don't leave, you may have to work directly with the former owner or go through the formal eviction process to get them out of the house. So, let's sum it up. If you want to purchase a home during any part of the foreclosure process, it may be possible to get a good deal. But it's also quite possible that you don't end up with that great deal at all. Remember that homes at different stages of the home foreclosure process might be in disrepair. A homeowner who cannot pay their mortgage often cannot pay for upkeep either. So when purchasing such a home, you may need to account for this and set funds aside for necessary repairs. Depending upon where the home is in the foreclosure process, purchasing it may require additional paperwork or longer time frame. You may also be limited in what you can request from the seller or bank, or in your ability to inspect the home fully. That's all from me today. Please make sure you like, subscribe, and share. Also, please send any comments and suggestions. We want to hear from you to make our channel Real Estate for Real with Arek and Elaine better. See ya until next time.